Hello, today is the 13th of September. Let's very quickly run through what happened last week and then look forward to what is likely to happen next week with the Fed. So this week we had, to me, the important thing was that the weekly unemployment claims for the first time in something like 4 months have finally exceeded the previous high in that series. And that is beginning to suggest that the economy is weakening and that the unemployment rate is potentially going to be a problem and that growth really should start slowing down in the US economy. Of course, 1 week's data does not prove anything, so we need to wait for next week's numbers to confirm. But the PPI numbers and the CPI numbers were fairly good. PPI was a big miss, and CPI, although it was 0.1 higher on one of the series, it really wasn't as bad as the market feared, and therefore it looks like inflation is not accelerating past the point that we all expect it to be by year end in PCE, which is around the 3% mark. Naturally, if the economy slows down, that is likely to be revised down as well. As a result, we had some very good auctions in the bond market, and we had the short end give up some room. So the 2-year note was actually 5 basis points higher, but the long end was between 5 and 7 basis points lower. And that is what we told you last week was likely to happen, that kind of a twist action in the bond market, which is presaging something like the Fed not being able to be dovish enough to really help the short end anymore, but being dovish enough and the economy not being strong enough for the long end to start performing. That is where we are. Naturally, all this could change very easily with more data and the Fed next week. I think the Fed is going to be completely data dependent. And of course, it will matter what the dot plots are at the FOMC and their projections for economic activity. But I just have the impression that they are going to be data dependent as well, and they're going to change their mind as to the dot plots as the data arrives. Andy, what do you think? What do you think we're likely to get from the Fed, and what the consequences for the markets could be? Because the current pricing is so dovish that it's very difficult for me to see a scenario in which actually the Fed outdoves the current pricing.
Yeah, that's really the trick here in terms of what's happening next week. Well, last week, we did have equities do quite well. NASDAQ was up 1.8%. S&P was up 1.5%. Russell didn't really do particularly well. So the idea of a slowdown that we think is ongoing and informs our bond market view just isn't showing up yet in equities, and may not show up this week either. But it feels like it's going to show up. And what is getting priced is this idea that the Fed is going to make everything better by easing adequately, just enough to offset any weakening in growth, to lower mortgage rates that'll stimulate the housing market, that'll stimulate the jobs market, that'll keep the job market strong enough. And so you'll get, without really triggering a big inflationary shock. And inflation's running through. It's running hot. As Nick rightly pointed out, the CPI and PPI were constructive for things like core PCE, which is the Fed's key measure. That number came down quite a bit in terms of the components of the data that we saw this last week affecting the thing the Fed cares most about. So going into the Fed, they are 100% going to cut 25 basis points. And I would put the odds close to zero. It's never zero, but close to zero that they cut 50. So they're going to cut 25. So that's the first headline thing that we're going to get. The next thing we're going to get is the dot plot, which is their quarterly projection of where the committee as individuals think the economy is going. We may have a new voter with Stephen Moran, who we know, as a governor to replace Adriana Kugler, who resigned. He's being voted on Monday, and he's going to be a dove. He's an administration person. He's clearly said he wants interest rates lower. He's going to be a dove. And so, along with Waller and Bowman, we've got three doves they may even vote for 50. I don't think they will, but they could. But they're not going to drag the committee over to 50 basis points. But we'll get to see their dots, and we'll get to see the rest of the committee's dots. The point that we're trying to make is that to the current short-term interest rate market has between close to 3 cuts priced in for 2025, which means a cut in every meeting going in September, and then two more cuts by the end of the year. I don't see the data or the members of the committee that will validate that view. So we're going to end up with a dot plot which says we're going to cut twice, which is the same thing we had. So that's not going to create a dovish influence. Longer term interest rates, there's some possibility that they could create a dovish outcome in that the 2026 expected Fed funds rate is basically 75 basis points of cuts between now and the end of 2026 versus today. And we know they're going to cut more than that if the data comes in as expected. But the market's already priced close to 150 basis points of cuts. So it's going to be, that dot would have to drop a lot for the committee to be trying to indicate that they support current market pricing. They're not going to be able to do that. So then you go into the plots. Now, could they be even more dovish than the market? Sure. For them to be more, it's very unlikely, but for them to be more dovish than the market, the whole committee is going to have to anticipate a significant change in unemployment rate. Currently, the dot for unemployment is for it to stay at 4.5, go to 4.5 for the next 2 years. They're going to have to pick a number like 4.7, 4.8 to justify current market pricing. And myself, I would be concerned if the Fed got so cautious on the labor market for equity markets. They would be essentially stamping a meaningful slowdown in the very short term. They're not going to do that. And so they're not going to be dovish enough. That means the 2-year note doesn't rally. That means the long end may rally, but not much. And it means the equity market is not likely to rally. It has rallied. It has rallied with this dovish pricing, but the dovish pricing has gone as far as it can go. So to me, it seems very clear that there's very little upside in assets broadly going into the FOMC, and in particular, equities have performed extremely well in the last month, primarily due to this easing idea.
Yeah, no, I agree with you. I find it very difficult to see how the Fed is going to out-dove the current pricing. And I think it's very unlikely that Steve Moran is going to be so pessimistic on the Trump economy that he can vote for a 50 basis point cut. I can't see how they can say that, yes, the unemployment rate is going to remain at 4.5% and then ask for a 50 basis point cut. Anything is possible, but it just seems to be unlikely intellectually to be able to carry the committee. One vote doesn't mean very much on the committee. So I find that unlikely to happen.
As a gentleman's bet, I expect one dot at least to have 100 basis points of cuts priced in 2020.
Yes, without a doubt, you could have one person doing it. But my argument is that he can't carry the committee. And if you can't carry the committee, the idea of a 50 basis point cut is just ridiculous unless you start getting data. Now, we're only talking about what's likely to happen next week. So we are saying that next week, before more data comes and before the weekly claims, because we are getting the FOMC on Wednesday, it's very unlikely that the markets can rally after the FOMC, unless Powell says something ridiculously dovish in the presser.
Which he will.
What can he say that is so dovish compared to the dot plots and compared to what they're expecting inflation and employment to be?
To me, he would have to
Anything is possible.
To me, he would have to say, we're not that concerned about the labor market, but we are going to cut rates a lot because we're no longer concerned at all about inflation. That could be dovish enough to get things ripping in both bonds and stocks. Like
wow. I'm not sure that the long end would like that very much, so I'm hoping that doesn't happen. It certainly wouldn't suit my positions, so I hope he doesn't do anything as stupid as that, although anything is possible, but I would give that very low odds.
Yeah, I'm trying to think of the way he can outdove the market without expressing concern about the labor market.
Yeah. And if we both agree that it's unlikely that is going to happen, what is the best thing to not be long of, kind of thing? Because if you say that I'm very concerned about equities at these levels, I'm getting a tingly sixth sense that something is not quite right. Do you think equities would fall more? Or do you think that equities would actually go sideways and not really care, and it would be bonds that fall? What's your feeling?
I'm in the slowdown camp. We've been in the slowdown camp. I've been a bit more aggressively in the slowdown camp for 3 months. We're getting the slowdown. That's good for bonds, bad for stocks, but stocks have done fine along with bonds doing well. And so to me, equities are more vulnerable because of that. Nick, you never really say that you have a spidey sense about equities on this program. I just want to highlight for our viewers, he doesn't really say that, doesn't really say it much to me in private, and I respect that. And so usually a bull got that spidey sense now. I think we're supposed to act on that, and certainly valuation, certainly positioning, everything else is supportive of equities giving a few 100-point sell-off. And listen, if the FOMC comes out super dovish, we're going to be wrong. But to what end? What's the upside? And so let's look at call selling. That may cause us to lock in a 3-4% further upside in our equity portfolio, but it's been a good run. And maybe it's time to say, let's lock what we've got in, or at least cap what we've got in for some payment up front.
I agree. High level point. The market is pricing in perfection plus. It's likely to get something approaching it from the Fed, but it's very unlikely to get more than that. And therefore, the likelihood of further significant upside in either bonds or equities is unlikely. Plus the fact that we are getting for the first time this increase in weekly claims, which I've been harping on about for months, and it could be confirmed by next week's, gives me an idea that if that were to happen, then equities are likely to give up some ground simply because of the level of valuation. And if bonds can't rally, then equities should be able to fall. In which case, selling calls might not be the most aggressive thing you can do, but it's certainly not something that's going to kill the performance of the portfolio. So I agree that it makes plenty of sense, and that's what I'll discuss in my segment.
Great.
I hope I've summarized your thoughts and mine accurately there, Andy.
Absolutely.
Great. Speak to you next week.